Hey, dear listeners, we need to let you know that Kevin and Stephanie offer investment advice through Private Advisor Group, which is a federally registered investment advisor. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations to any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Now let's get on with the show. This is Take Back Retirement, the show that's redefining retirement for women. Retirement is an old-fashioned cultural concept. We want to reclaim the word so you can make it your own. I'm Stephanie McCullough, financial planner and founder of Sophia Financial, where our mission is to reduce women's money stress and empower them to make wise, holistic decisions so they can get back to living their best lives. Kevin Gaines is my longtime colleague with deep knowledge in the technical stuff, investments, taxes, and retirement plan rules. He's a little bit geeky and quantitative. I'm a little bit touchy-feely and qualitative. Together, through conversations and interviews, we aim to give you the information and motivation you need to move forward with confidence. We're so glad you're here. Coming to you semi-live from the beautiful Westlakes Office Park in suburban Philadelphia, this is Stephanie McCullough and Kevin Gaines of Sophia Financial and American Financial Management Group. Say hello, Kevin.
Hello, Kevin.
So today the topic we want to give an overview of is one that we hear people getting wrong a lot. We hear people getting confused about it, and rightly so. Let's be clear. It's a super confusing topic, and we're talking taxes. We're talking the estate and gift tax system, which is very different and separate from the income tax system. And yet these are two federal tax systems that everyone should really kind of be aware of when they're thinking about their retirement planning.
And before we go any further, Stephanie, I need to correct you on something.
Tell me.
People probably yell at us all the time. It's just with the beauty with the podcast is we don't have to listen to it.
That's true. We don't hear it.
But seriously, yeah, frequently, when we're having conversations with clients and people trying to figure this stuff out, it's, oh, well, I don't have to pay tax on it. Well, yeah, you don't have to pay income tax on it, but you still got to deal with the estate tax. Or, it bypasses the estate, but somebody's paying tax. Here it is. At the end of the day, the IRS is getting paid.
Oh, yeah.
Who and when? That's what all this is about. It's not if you're going to pay tax, it's when you pay the tax.
And being smart about it, right? Planning ahead. We're not advocating, skipping out on your taxes either. We're just trying to give you, this is going to be a super high level overview, very big picture. Obviously, we recommend everybody work with tax professionals when you're in the weeds dealing with this on your personal situation. And at the same time, we think it's useful to have a big picture understanding of the estate and gift tax system.
Right. Because if your accountant says, hey, we should do this, or your estate planner says we should do that, you're just going to sit there and go, okay, sure. If you don't have this higher level, if you're at least not aware of the vocabulary, you're just going to be completely lost and who knows what you end up doing. So, hey, this is this.
And our first point is just that, right? That these are very two distinct systems. The income tax system is extremely different from the estate and gift tax system. They've actually got nothing to do with each other. And the same dollar or multiple dollars can be taxed both ways. And as Kevin was saying, avoiding tax in one of the systems doesn't really tell you anything about how it's going to be treated in the other system.
Right. Hey, let's start for the weeds right now. And first thing we want to talk about is the estate tax. So you hear the terms estate and gift. For the purpose of this conversation, they're essentially the same thing. So the gift tax is stuff when you're alive. The estate tax is when you're dead.
It's all the same thing. Like in the federal tax code, the estate and gift tax, they're connected. And we'll explain why. But yeah, the point is these things go together.
And probably one of the easiest ways to try to keep this straight is think of when we're talking estate and gift taxing, we're talking about a disbursement tax. The money is being sent out. Again, whether you're alive or dead, separate conversation, but it's money you're giving out and how much of it is going to be taxed and at what rate.
And the tax is on the giver or the person bequeathing it, not on the receiver.
Right. And again, getting back to income tax versus estate and gift tax. Yes. Estate tax on the giver, income tax on a receiver.
Mm-hmm.
You receive a wage, you pay an income tax.
And we do want to point out too, here's our second caveat. First caveat, get help from a real certified tax professional. Second caveat, we're talking about federal systems. States are a whole different ballgame. As you know, there's 50 of them, plus some territories. They have their own systems, and we're not even going there, right? Some states have an estate tax, which we just said was a disbursement tax, a tax on the one who is giving. Some states, like the one we happen to live in, Pennsylvania, have an inheritance tax, which is a tax on the receiver, and it's wacky. So pay attention to your states. We're not talking about that today.
So first thing we need to talk about, Stephanie, is exclusion amounts.
Yes.
So what are exclusion amounts?
So in both of these situations, a gift, which is when you're living, and estate tax when you've passed away, there's an exclusion, which is the amount that you can pass on with no tax, right? It's kind of like a deduction. It's the amount that you can pass without tax being levied.
So why are these exclusion amounts important? Well, if you are below the exclusion amount, no tax. IRS doesn't care. Mm-hmm. You're home free. Do whatever you want below that amount. They're good. Anything over and above that exclusion amount, that's when they're sticking out their hand saying, gimme, 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 when it comes to these taxes. That's why the numbers come into play so much. Now, if you happen to be married, there's yet another number to worry about. Well, technically, it's not a number. It's a symbol. It's a little 8 on its side. Unlimited. Well, technically, that's infinity. But if you are married, you can pass an unlimited amount of money to your spouse, either in terms of a gift or estate.
Mm-hmm. It's called the unlimited marital deduction. So no tax if you are giving something to your spouse, again, while you're living or after you've passed away.
Right. That's a key thing. In most people's estate plans is, it all goes to the wife, the husband, whoever. As long as you're married, IRS says, good, have fun with it. Again, states may have their own rules, but just to reiterate, we're talking about federal on this stuff. So there's our exclusion definition. Stephanie, gift tax, this lifetime giving, what's it all about?
So the gift tax, or what most people think about actually when they're thinking about annual giving is, and we're not talking about charities now. Charities, that's to do with the income tax, right? You can get deductions if you donate to charities, and there's rules around that. Not talking about that. We're talking about when you're giving to another person. This is a person-to-person gift of assets or cash during your lifetime. There is an annual gift tax exclusion, an amount that you can give to someone with no tax being levied. And a lot of people have this number in their heads. Last year, 2021, it was $15,000. Things go up periodically with inflation. This year, 2022, it's $16,000 that I could give to anyone of my choosing with no tax. And in fact, I could give to as many anyone's as I felt like. I could give $16,000 to Kevin. I could give $16,000 to my cat groomer. I could give $16,000 to the person who cuts my hair. All in gifts and no tax.
Note, Stephanie, did you mention anybody you were related to in that example?
Not today.
So that's a key point about the gift tax. This isn't blood relations or connected legally or anything. You could literally give $16,000 to the first person you meet on the street. And as far as the IRS is concerned, that's just as good as giving it to a grandchild or sibling or whatever. So this 16,000 in 2022, this is a person-to-person number. So it's not tax return to tax return. A lot of moving parts here. In an attempt to clarify this, let's go with an example. Let's assume you've got grandma and grandpa, and they have 2 kids, and those kids are married, and they each have 2 kids. So for the purpose of this part of the example, we're talking about 8 people, right? How much can you give, Stephanie?
Well, grandma could give $16,000 to each kid's spouse, and each grandkid. But grandpa can also give $16,000 to each kid's spouse, and each grandkid. So this is the person-to-person part. It's not talking about a tax return, right? So a married couple, if they're filing jointly, is one tax entity. However, the gift tax exclusion applies to individuals. So each spouse can give the $16,000 to each person.
Right. And then say they really like the neighbor kid who, helping them out, mowing their yard, whatever, this kid's done to curry their favor, so to speak. Can they give another 16 or even 32,000, Stephanie?
Sure. Again, it's not family connected at all, right? So grandpa could give to each of these family members, and they could each give 16,000 to the neighbor kid. So if we add that up, that's 9 people, each receiving 16 from grandma, 16 from grandpa. That's $288,000 in 2022 that grandpa could be gifting in our example. Now this kind of gets to the connection part of it, right? Why do they want to do this? Because they love their family and they love the neighbor who mows the lawn. But from a tax perspective, why would they want to be gifting this money, Kevin?
Well, now we get back to the simple answer: reduce their estate. How do you want to reduce your estate? It's simple because there's this other number to worry about, the estate tax exemption, which is, for 2022, a little over $12 million. When you die, if your estate is under $12 million, you don't have to pay your estate tax. Or tax rate is 0. It's an exclusion amount. And if you're over that, then obviously you're going to have to pay some sort of tax, and that tax rate is up to 40%. So, it's something you ideally would like to avoid if you can. If your estate's 100 million, you're probably not going to be able to reduce it, so you're not going to worry about it. But, you're looking at the numbers and, hey, we're at 12.5 million or 13 million. Then, maybe you want to do some things to try to lower that number, assuming you care about your beneficiaries. Because, to be brutally honest, you're dead. You may not say, hey, they're going to get it all anyway. If they got to pay some tax, go for it. But let's assume you do want to try to maximize how much your beneficiaries inherit. So doing some gifting while you're alive will allow you to reduce that number and avoid paying the IRS any more money than you have to.
So this estate tax exclusion, right? Each individual gets, again, on this estate and gift taxes, it's individual by individual. You get this lifetime exclusion amount, it's called. So Kevin mentioned right now it's a little bit over $12 million, but that number bounces around all the time, right? Congress changes the tax laws a lot. So previous to the current tax law that's in force, it was around $5 million per individual. Well, $5 million is a lot less than $12 million. And we're not going into all the details of tax law and how law is made, because that's sausage making and we don't want to dive in there. However, the current law as it stands is set to sunset, which means, fade out into history on January 1st of 2026. So if nothing changes, it probably will, but if nothing changes, that lifetime exclusion amount goes down from 12 million to 5 million in 2026. So if you're sitting there thinking, well, hey, all the stuff I own is only about $6 million and the exclusion's 12, I don't have to worry about it. Right? Things bounce around. Just know that Congress can change their minds anytime they feel like it.
And frequently do.
Yeah.
12 million may sound like a lot of money, but it can also add up fast. Something to be aware of.
Because your home's included there.
Homes, if you own a farm, maybe you own a farm far, far away from everybody. All right, so the land isn't worth all that much. But as you get this, what they call it, suburban sprawl, all of a sudden you may find your land values going up, and you could easily end up over the 12 million through no fault of your own.
Heck, owning a business. If anybody
owning a
owns some
business.
Bitcoin, like you never know. You never know, right? So
Right.
again, we just want to arm you with a little bit of this information. Now, here's an important part. Again, remember we mentioned that unlimited marital deduction. So if I have $20 million and I pass away, it can all go to my spouse with no tax. But Kevin, there's something else that also passes to my spouse in that example.
Yes. The fun part, which is the exemption amount, which means you have $12 million and you pass it all to your spouse. You actually didn't use any of that exemption amount because it all went to your spouse and no tax was due. So the surviving spouse now has, for 2022, $24 million of room.
So their lifetime exclusion goes from 12 to 24.
Right. So now all of a sudden, hey, the math's going to change. You don't have to worry about this smaller, quote unquote, smaller amount. You now have a lot more room to play with.
Meaning not be taxed on.
Meaning not be taxable. So now all of a sudden, going back to our farm being impacted by suburban sprawl, yeah, hey, maybe now it's not as big of an issue. And this was actually part of the reason they brought this transfer of the exemption amount in, was to account for a lot of this family stuff, family-owned business, farms, joint assets. They exist. So, I mean, in a nutshell, there's your estate tax number. So it's $12 million. If you don't use it, again, for 2022, you don't use it, passes to your spouse, and voila, there's more money that can be passed to whoever you want. However, one thing, and this gets back to the intro with Stephanie that you were saying, talking to people in hardware stores, there are misconceptions. There are stuff we hear. So, Stephanie, what would you say is probably the biggest misconception when it comes to this gift tax?
The one I hear all the time from clients, from friends, is that, well, my parents can only give me $16,000 a year. Like there's somebody in the federal government who's going to come, knock on their door and hand them a ticket if they give more than that annual exclusion amount. And that's not true. You can gift more than the $16,000 to any one individual. And here's again where the systems are connected. What happens is, let's say I feel like giving anybody, not my spouse, because that's unlimited. Want to give someone $20,000 in a year. I could choose to pay gift tax, but that's silly. What I would do instead is file one extra piece of paper, one extra form with my tax return saying that I have used $4,000 of my lifetime exclusion amount this year to gift to this individual. So I can actually give as much as I want. I can give $100,000 to somebody and use 100,000 minus 16 of my lifetime exclusion in this year. And then, of course, I need to file that piece of paper. I need to keep track that when I pass away, right, my estate would have the 12 million minus the 100,000 that I gifted in 2022.
Question for you. What if, for whatever reason, you give away $12 million this year?
Yeah.
Now it's 2026, 2027, and miraculously, the Congress hasn't played with the estate tax limits or anything, and we've dropped back down to $5 million. What happens to that $7 million, the difference between the 12 this year and the 5 in 2026?
Yeah. So that's interesting, right? Because in effect, because they're connected and yet the gift is annual and the estate tax is lifetime, if I choose to gift and use up all my lifetime exclusion in 2022, I can do that. And that's going to be governed by the amount in 2022. And then let's say I pass away in 2027. Hopefully it's a lot longer than that. But I pass away when the exclusion's a lot lower than that $12 million. There's no repercussions. They're not going to come back at my estate and say, oh my gosh, she owes estate tax on $7 million. That's not how it works. So it's kind of an interesting interplay between this annual gift tax and a lifetime estate tax.
Right. And to clarify, So if you use the 12 million, all the 12 million this year, you now have zero.
Correct.
So when you die, even if you only have $2 left in the bank, that $2 is subject to estate tax.
Unless the lifetime exclusion is 24 million or, turns into 50 million when I die. Then I've only used 12, right?
Exactly.
Yeah. But assuming that I've used it all up, then yes, anything I own that's in my estate, right? And the estate is everything that an individual owns at the time of their death, right? That's what's calculated, added up to figure out what the estate tax is. Anything I own would be taxed in that situation because I'd already used up my exclusion. But what that means is back to our grandma and grandpa example, right? They're not limited to gifting the $16,000 per each person. Let's say they wanted to give $25,000 each to the 2 kids, the 2 spouses, the 4 grandkids, and the kid who mows the lawn, right? That's $450,000 out of their estate just for adding one more form to their tax return saying that they've used some of their lifetime exclusion this year.
Right. So it comes down to the name of the game is if you are a little bit over that number, you're going to be looking for ways to lower that number.
What number?
The estate, the value of your estate. Good point. Yeah, you want to reduce that. If you're just a little bit over, it's going to be worth gifting or, other things to do that. So understand, annual doesn't exclude being able to use the bigger number if you want to, right, and still avoid having to pay a gift tax.
Yes, exactly. So yeah, the misconception I hear is they're not allowed to give more than 16 or they're going to pay tax if they give more than 16, but that's not true. All right, Kevin, what's a big misconception that you hear? In fact, you've been hearing quite a bit last week and this week.
Yes, working with, unfortunately, I had a client pass away and been working with her kids on a lot of these details. Interestingly, her estate is a little over this amount. And we were, talking about different things we can do to reduce that amount. And one question that has come up is trying to avoid probate and the estate taxes. Here's the popular misconception. Oh, I want to avoid probate because if I can do that, then I'm not going to pay estate tax. Incorrect. The two have nothing to do with each other.
What is probate, Kevin, in a 30-second overview?
Probate is basically the court saying a blessing over your will. And anything that's going to pass through your will, the court's going to have to say, is going to have to approve. And normally it's just a signature. The big problem with probate is it has some cost, but it's more of an inconvenience and it takes time to have to deal with the court system in order to get this money dispersed.
And back to our episode 31 on trusts, right? It's also public. Not that anyone's necessarily looking, but that's public record, anything that passes through probate.
Real quick example. Every time a celebrity dies without a will, not let alone the estate planning, it's always, well, at least among us, it's always big news. It's like, oh, how could somebody so rich and famous make these estate planning mistakes? We know they made the mistakes because the stuff is public. It's going through probate. Mm-hmm. So that's, avoiding probate is convenience and privacy. So how do you avoid probate? You pass it through beneficiaries instead of through the will. Oversimplification, but that's pretty much it in a nutshell. IRAs, they pass by beneficiary forms. Life insurance, pass through by beneficiary forms. So those avoid probate because they didn't go through the will. Unless, of course, you made your beneficiary your estate or your will. But that aside. But it's still part of your estate. If you have $6 million IRA and a $10 million life insurance policy, you have a $16 million estate. Zero probate.
Yeah.
But your estate is $16 million, and now we're possibly talking estate taxes. Yeah, so understand, in a nutshell, you avoid probate to simplify your life, not to avoid taxes.
So we hope you found this helpful. We tried to keep it concise. That's sometimes a challenge with us, but we wanted to just equip you with an overview of this estate and gift tax system, right? They're connected. There's annual stuff. There's a lifetime stuff. There's an unlimited marital deduction. Some of these key pieces of information we hope you'll find useful in planning, in thinking about, and dealing with family members, right? We're of an age where family members are, starting to pass away. Maybe you're going to have to be executor or, involved in some things. So hopefully you found this helpful. We appreciate your joining us as always. Thanks for being with us. We'll talk to you next time. It's goodbye from me.
And it's goodbye from her.
Be sure to subscribe to the show and please share it with your friends. Show notes and more information available at takebackretirement.com. Huge thanks for the original music by the one and only Raymond Loewy through New Math in New York. See you next time.
Investment advice offered through Private Advisor Group, LLC, a registered investment advisor. Private Advisor Group, American Financial Management Group, and Sophia Financial are separate entities. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual security. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. This information is not intended to be a substitute for individualized tax advice. Please consult your tax advisor regarding your specific situation.